Hello and welcome. Over the next several chapters, we will embark on a journey to understand a powerful concept in modern personal finance: the Finance Hub. Before we begin, it is essential to state that the information provided in this entire series is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, investment, legal, or tax advice. Personal financial situations are unique, and any decisions you make should be based on consultation with qualified professionals who can assess your individual needs. This content is designed to provide a broad overview and should not be used as a substitute for professional guidance. Now let's start with a simple question. Does managing your money ever feel complicated? You might have a checking account with one bank, a savings account with another, a 401k from your employer, a separate IRA, a mortgage, a car loan, and several credit cards. Each of these financial products lives on a different website, with a different login and a different statement. It can feel fragmented, overwhelming, and difficult to see the big picture of your own financial health. This is where the idea of a finance hub comes into play. So, what exactly is a finance hub? When you hear the term, you might first think of a major global city like New York, London, or Tokyo, places where global finance converges. And while that is one definition, for our purposes, we are focusing on a more personal, practical application. A personal finance hub is a centralized system or framework for managing all the different aspects of your financial life. Think of it as a control center or a dashboard for your money. Its primary goal is to bring clarity, organization, and efficiency to how you interact with your finances. It's a concept that transforms a scattered collection of accounts and debts into a cohesive, understandable system. A finance hub isn't necessarily a single product you can buy, although some apps and platforms are designed to function this way. More broadly, it's an approach. It's about intentionally creating a central point, whether physical, digital, or mental, from which you can monitor, manage, and direct your financial activities. Let's break down the different forms a finance hub can take. First, there's the digital finance hub. This is perhaps the most common interpretation in our modern, tech-driven world. A digital hub could be a single, powerful financial aggregation app that links all of your different accounts in one place. These applications can pull data from your bank accounts, credit cards, investment portfolios, and loans, presenting you with a real-time, comprehensive view of your net worth, cash flow, and budget. They provide the ultimate dashboard, allowing you to see where your money is going and how your investments are performing without logging into a dozen different websites. Second, a finance hub can be a specific financial institution. For some people, this means consolidating their services with one large bank or credit union. They might have their checking, savings, credit card, mortgage, and investment accounts all under one roof. The benefit here is simplicity and relationship building. It's often easier to manage transfers, and you have a single point of contact for most of your financial needs. This traditional model has been the go-to approach for generations. Third, a finance hub can be a professional human relationship. For many, their finance hub is their trusted financial advisor or planner. This individual acts as the central coordinator. While your accounts might still be at different institutions, the advisor is the one who has the complete view and helps you make sure all the pieces are working together toward your goals. They are the strategic center of your financial world. Finally, and perhaps most fundamentally, a finance hub can simply be your own personal system. A spreadsheet you've meticulously crafted, a specific time you set aside each week to review your finances, and a clear set of rules you follow for saving, spending, and investing. In this case, you are the hub. This approach requires discipline, but offers complete control and customization. So, why is this concept so important today? The financial landscape has grown increasingly complex. Decades ago, most people had a simple checking and savings account, maybe a pension through their employer, and a mortgage. Today, we are faced with an explosion of choices. High-yield savings accounts, robo-advisors, brokerage apps, cryptocurrencies, dozens of credit card reward programs, and various types of retirement accounts like the 401k, Roth 401k, IRA, and Roth IRA. Without a central system to manage this complexity, it's easy to lose track. You might be paying unnecessary fees, missing opportunities to optimize your savings, or failing to see how one part of your financial life impacts another. For instance, high credit card debt could be undermining the gains you're making in your investment account. Without a holistic view, these connections are easy to miss. A well-structured finance hub aims to solve these problems by achieving a few key objectives. First, it provides visibility. The first step to taking control of your money is knowing exactly where it is and what it's doing. A finance hub gives you that 360-degree view. Second, it promotes efficiency. By centralizing management, you save time and mental energy. Instead of juggling multiple logins and statements, you have a streamlined process for reviewing and managing your finances. This makes tasks like budgeting, tracking expenses, and paying bills much simpler. Third, it enables better decision-making. When you can see the entire picture, you are better equipped to make informed choices. You can see how much you can afford to invest, how quickly you can pay down debt, and how you are progressing toward major goals like retirement or buying a home. It connects your daily financial habits to your long-term aspirations. Throughout this series, we will explore the essential components that make up a comprehensive personal finance hub. We'll look at the foundational pillars, starting with banking and cash flow management. We'll then move on to understanding credit and debt, and how to manage them strategically. We will delve into the world of investing, from retirement accounts to general brokerage accounts. We will also touch upon the crucial roles of insurance and long-term financial planning, including estate and tax considerations in a general sense. Our goal is not to tell you what to do, but to provide you with a map, a framework for thinking about your financial life in a more organized, integrated, and empowered way. By the end of this series, you will have a clear understanding of how to design and build a personal finance hub that works for you, helping you navigate the complexities of the American financial system with greater confidence. Thank you for joining me for this introduction. In our next chapter, we will dive deep into the first and most critical pillar of any finance hub, banking and cash flow management. We'll explore how to structure your bank accounts to create a system that automatically works toward your financial goals. Welcome back. In our first chapter, we introduced the concept of a personal finance hub, a central system for bringing clarity and control to your financial life. We established that this hub is your command center for managing money. As a continued reminder, the information presented here is for educational purposes only and should not be considered financial, legal, or tax advice. Always consult with a qualified professional for guidance tailored to your unique circumstances. Today, we're laying the very first stone of that hub. We're building the foundation upon which everything else, investing, debt management, and long-term planning, will rest. This foundation is your banking and cash flow management system. Think of it like building a house. You wouldn't start with the roof or the windows. You would start by pouring a solid, level, and strong concrete foundation. If the foundation is weak, the entire structure is at risk. In personal finance, your day-to-day banking setup and how money moves through it, your cash flow, is that foundation. Get this part right, and everything else becomes more stable and easier to manage. The goal of this system is simple: to create a clear and automated pathway for your money. We want to direct every dollar that comes into its proper job, whether that job is paying a bill, saving for a future goal, or building long-term wealth. A widely discussed and effective way to structure this foundation is by using a system of specialized accounts. Let's explore a conceptual three-account structure that can bring immense clarity. First, we have the operating account. This is typically your primary checking account. Its role is to be the central transit station for your finances. All of your income, such as paychecks, side hustle earnings, or any other deposits, should flow directly into this account. Similarly, all of your regular, predictable expenses should flow out of it. This includes your rent or mortgage payment, utility bills, car payments, insurance premiums, and credit card payments. The key to the operating account is to treat it purely as a processing hub. It's not a place to store large amounts of savings. Its purpose is to manage the monthly ebb and flow of your financial obligations. When choosing a checking account, one might consider factors like low or non-existent monthly maintenance fees, the quality of its online and mobile banking platform, and whether it offers features like free online bill pay, which can be a cornerstone of automation. Second, we have the short-term savings account. This account is fundamentally different from your operating account. Its purpose is to hold money for specific goals that are on the near-term horizon, typically within the next 1 to 5 years. Most importantly, this is the ideal home for your emergency fund. Financial experts often emphasize the importance of having an emergency fund. This is a pool of readily accessible cash, set aside to cover unexpected life events, such as a job loss, a medical emergency, or an urgent home repair. A common guideline suggests saving enough to cover 3 to 6 months' worth of essential living expenses. The purpose of this fund is to provide a financial cushion that prevents you from going into debt when emergencies strike. Other goals for this account might include saving for a down payment on a home, a new car, or a planned vacation. The money here needs to be safe and liquid, meaning you can access it quickly without penalty. For this reason, many people explore options like high-yield savings accounts, or HYSAs. These accounts are designed to function just like traditional savings accounts, but generally offer a significantly higher annual percentage yield, or APY. This allows your short-term savings to grow a little faster while remaining secure and accessible. A critical feature of this account is that it should be separate from your main operating account to reduce the temptation of spending it on non-essential purchases. Finally, we have the long-term wealth funnel. This isn't a single account so much as a pathway. This is the designated route for money that is leaving your daily operating system to go work for your long-term future. This is the money you won't need for at least 5 years, and likely much longer. After your income arrives in your operating account, and after you've paid your bills and allocated money to your short-term savings, any surplus is directed down this funnel. This is the money that will fund your retirement accounts, like a 401k or an IRA, and other investment accounts. We will dedicate several future chapters to exploring what happens to the money in this funnel. But for now, the crucial step is simply creating the pathway for it to flow consistently. Now let's talk about the engine that drives this entire system: cash flow. Cash flow is simply the net amount of cash moving into and out of your accounts over a period of time. Positive cash flow means more money is coming in than is going out. This surplus is the raw material for building wealth. Negative cash flow means you're spending more than you earn, which is an unsustainable situation. Understanding your cash flow is not about restrictive budgeting or tracking every single penny. It's about awareness. It's about knowing, in broad terms, where your money is going. Modern banking apps and financial tools can often categorize your spending automatically, making it easier than ever to see how much you're spending on housing, transportation, food, and entertainment. Once you have this clarity, you can make informed decisions. The true power of this foundational system is unlocked with one final concept: automation. Automation is the secret to making your financial hub work for you, rather than you constantly having to work on it. It's the set it and forget it principle applied to your finances. Here's how it works in practice. Your paycheck is directly deposited into your operating account. Then, you set up automatic transfers. The day after your paycheck hits, you can have an automatic transfer move a fixed amount of money from your operating account to your short-term savings account. You can set up another automatic transfer to move money into your investment account, your long-term wealth funnel. You also set up your recurring bills, like your rent, utilities, and car payment, to be paid automatically from your operating account. This strategy, often called paying yourself first, ensures that your savings and investment goals are treated as non-negotiable bills. The money is whisked away before you even have a chance to spend it. Automation builds financial discipline directly into your system, requiring no ongoing willpower. It makes saving consistent and effortless. In summary, the bedrock of a strong finance hub is a banking structure that gives every dollar a job, a clear understanding of your cash flow, and a commitment to automating the system. By setting up a dedicated operating account, a short-term savings account, and a pathway to your long-term investments, you create a powerful and resilient foundation for your entire financial future. Thank you for joining me. In our next chapter, we will build directly on this foundation by tackling a topic that is a major source of stress for many: understanding and managing credit and debt. Hello and welcome back to our series on building your personal finance hub. In our last chapter, we established the bedrock of our system, a streamlined banking and cash flow setup. We created a solid foundation. Now it's time to build the next level of our structure by addressing one of the most powerful and often misunderstood forces in personal finance: debt and credit. As always, let's begin with our important reminder. This content is for informational and educational purposes only. It does not constitute financial, legal, or investment advice. Your situation is unique, and you should always consult with qualified professionals before making any financial decisions. In the United States, the concept of credit is deeply woven into the financial system. From getting a cell phone plan to buying a car or a home, your credit history plays a pivotal role. It's essential to understand that debt is a tool. Like any powerful tool, it can be used to build and create opportunity, which is leverage. Or if mishandled, it can become a heavy burden, a liability. Our goal today is to demystify this tool so you can approach it with clarity and confidence. Let's start with the basics: your credit report and your credit score. Think of your credit report as your financial resume. It's a detailed record of your history as a borrower, compiled by 3 major credit bureaus: Equifax, Experian, and TransUnion. This report lists your credit accounts such as credit cards, mortgages, auto loans, and student loans. It shows when you opened them, what your credit limits are, your current balances, and most importantly, your payment history, whether you've paid on time or have had any late payments. Your credit score, on the other hand, is like the final grade on that resume. It's a 3-digit number, typically ranging from 300 to 850, that summarizes all the information in your report at a single moment in time. Lenders use this score as a quick way to assess the risk of lending money to you. A higher score generally indicates a lower risk, which can lead to better interest rates and more favorable loan terms. The most common scoring models are FICO and VantageScore. While the exact formulas are proprietary, these scoring models generally look at 5 key factors. Understanding them is crucial. Payment history. This is the single most important factor. It answers the fundamental question: do you pay your bills on time? A consistent history of on-time payments has a positive impact on your score. Amounts owed. This looks at how much debt you carry relative to your total available credit. A key metric here is the credit utilization ratio, which primarily applies to revolving credit like credit cards. It's calculated by dividing your credit card balances by your total credit limits. For example, if you have a $1,000 balance on a card with a $10,000 limit, your utilization is 10%. A lower utilization ratio is generally viewed more favorably. Length of credit history. This considers the age of your oldest account, your newest account, and the average age of all your accounts. A longer history of responsible credit management can have a positive influence. Credit mix. This refers to the different types of credit you have, such as credit cards, retail accounts, installment loans like a mortgage or car loan, and finance company accounts. Lenders often like to see that you can manage various types of credit responsibly. New credit. This factor looks at how many new accounts you've recently opened and how many hard inquiries are on your report. A hard inquiry occurs when a lender checks your credit for a lending decision. Opening several new accounts in a short period can sometimes be seen as a sign of risk. It's a good practice to review your credit report regularly. Under federal law, you are entitled to a free copy of your report from each of the 3 bureaus once every year through the official website, annualcreditreport.com. Checking it allows you to spot any errors and understand your financial standing. Now let's talk about the nature of debt itself. In financial discussions, debt is often categorized into 2 general types, sometimes referred to as good debt and bad debt. Good debt is a term often used to describe money borrowed to purchase an asset that has the potential to increase in value or generate future income. The most common examples are a mortgage to buy a home, which can appreciate over time, or a student loan to fund an education that could lead to a higher-paying career. Even then, it's critical to borrow responsibly, as this is still a significant financial obligation. Bad debt, on the other hand, is a term typically used for debt taken on to purchase depreciating assets or for consumption. High-interest credit card debt for things like vacations, dining out, or electronics is a classic example. The item purchased loses value, but the debt remains, often growing due to high interest rates. Understanding this distinction can help in prioritizing debt repayment. Many people focus on reducing or eliminating high-interest, bad debt, as a top financial priority. When it comes to creating a plan for paying down debt, there are 2 widely discussed strategies that people often consider. It's helpful to understand the philosophy behind each. The first is the debt avalanche method. With this approach, you make the minimum payment on all of your debts. Then you take any extra money you have and apply it to the debt with the highest interest rate. Once that debt is paid off, you roll that entire payment amount over to the debt with the next highest interest rate, and so on. Mathematically, this method will save you the most money in interest over time, because you are tackling the most expensive debt first. The second is the debt snowball method. Using this strategy, you again make the minimum payment on all debts, but you direct any extra money to the debt with the smallest balance first, regardless of the interest rate. Once the smallest debt is paid off, you take that full payment amount and apply it to the next smallest debt. The idea here is to leverage psychology. Paying off a debt completely, even a small one, can provide a quick win and a powerful motivational boost to keep you going. Neither method is universally correct. The choice often comes down to whether an individual is more motivated by mathematical optimization or by psychological momentum. Ultimately, managing credit and debt within your finance hub means using them intentionally. It means understanding your credit profile, being mindful of the type of debt you take on, and having a clear, systematic plan for repayment. This control over your liabilities is what allows you to build a stronger financial future. Thank you for joining me. In our next chapter, we will shift our focus from liabilities to assets, exploring the exciting world of the long-term wealth funnel. An introduction to the principles of investing. Hello and welcome back. In our journey so far, we have built the essential framework for our personal finance hub. We established the concept in Chapter 1, laid the foundation with banking and cash flow in Chapter 2, and learned to manage liabilities with credit and debt in Chapter 3. Today, we turn our attention to the future. We're going to explore the engine of our hub, the long-term wealth funnel, which is the world of investing. Before we proceed, it is absolutely critical to restate our guiding principle. The information provided in this chapter is for educational and informational purposes only. It is not, and should never be taken as, investment advice. Investing involves risk, including the potential loss of principal. The concepts discussed here are general in nature, and any investment decisions should only be made after consulting with a licensed and qualified financial professional who can understand your personal situation, goals, and risk tolerance. So, what is investing? At its core, investing is the act of using your money with the expectation that it will generate more money over time. It's fundamentally different from saving. Saving is typically for short-term, specific goals, like an emergency fund or a down payment on a car. The primary goal of saving is capital preservation. You want the money to be safe and easily accessible. Investing, on the other hand, is a long-term strategy. It's for goals that are 5, 10, 20, or even 40 years away, like retirement. With investing, you are accepting a certain level of risk with the potential for your money to grow at a rate that outpaces inflation, thereby increasing your future purchasing power. To understand investing, we first need to know about the basic building blocks, which are called asset classes. Let's touch on a few common ones. First, we have stocks, which are also known as equities. When you buy a stock, you are purchasing a small ownership stake, a share, in a publicly traded company. If that company does well, and its value increases, the value of your share may also increase. This is called capital appreciation. Some companies also distribute a portion of their profits to shareholders, which are known as dividends. Stocks offer the potential for significant growth, but they also come with higher risk, as a company's value can also decrease. Next, there are bonds, also known as fixed income securities. When you buy a bond, you are essentially lending money to an entity, which could be a corporation or a government. In return for your loan, the issuer promises to pay you periodic interest payments over a set term, and then return the original amount of the loan, known as the principal, at the end of that term. Generally, bonds are considered to be less risky than stocks, but they also typically offer lower potential returns. These are just two of the major asset classes. Others include cash equivalents, which are very low-risk investments, and real estate. Regardless of the asset class, there are several fundamental principles that are central to the philosophy of long-term investing. The first is the relationship between risk and reward. This is perhaps the most important concept in all of investing. In general, assets that have the potential for higher returns also come with a higher level of risk. Conversely, lower-risk assets typically offer lower potential returns. There is no such thing as a high-return, no-risk investment. Understanding your own personal comfort level with risk, known as your risk tolerance, is a key part of developing any long-term strategy. The second principle is time horizon. This refers to the length of time you expect to hold an investment before you need to access the money. Time is a powerful ally in investing. A longer time horizon, like that of a young person saving for retirement, may allow an individual to take on more risk because their portfolio has more time to recover from market downturns. Someone closer to retirement, however, might have a shorter time horizon and may focus more on preserving their capital. The third principle is the power of compounding. Often described as a snowball effect, compounding is the process of your investment earnings generating their own earnings. When your investments produce returns, those returns get reinvested and can also start to grow. Over a long period, this can lead to significant growth. It highlights the benefit of starting to invest early, even with small amounts. The fourth key principle is diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." That is the essence of diversification. It is a strategy that involves spreading your investments across various asset classes, industries, and geographic regions. The goal of diversification is to help manage risk. The idea is that if one part of your portfolio is performing poorly, other parts may be performing well, potentially smoothing out your overall returns. It's important to remember that diversification is a risk management technique. It does not guarantee a profit or protect against losses in a declining market. So where does this investing take place? Investments are held in specific types of accounts. Broadly speaking, these fall into two categories. First, there are tax-advantaged retirement accounts such as a 401k, often offered by an employer, or an individual retirement arrangement, IRA, which you can open on your own. These accounts are designed specifically for long-term retirement savings and offer special tax benefits, such as tax-deferred growth or tax-free withdrawals in retirement, depending on the account type. Many employers offer a matching contribution for a 401k, which can be a powerful incentive to save. Second, there is the standard taxable brokerage account. This is a general-purpose investment account with no special tax benefits, but also no restrictions on when you can withdraw your money. Finally, how do people achieve diversification without buying hundreds of individual stocks and bonds? Many do so through investment vehicles like mutual funds and exchange-traded funds, ETFs. Both are essentially collections of dozens or even hundreds of different stocks, bonds, or other assets, all packaged into a single investment. They offer an immediate way to diversify and are a common building block in many long-term investment portfolios. In summary, investing is the long-term engine for growth in your finance hub. It involves understanding the basic asset classes, being guided by core principles like diversification and compounding, and using the appropriate accounts for your goals. Thank you for joining me. In our next chapter, we will delve deeper into one of the most critical financial goals for most Americans: planning for retirement. Hello and welcome back. In our last chapter, we introduced the fundamental principles of investing, the engine designed to drive long-term growth in your finance hub. Today, we're going to apply those principles to what is, for many Americans, the single largest and longest-term financial goal of their lives: retirement. As we dive into this critical topic, our standard disclaimer is more important than ever. This chapter provides a general, educational overview of retirement planning concepts in the United States. It is not financial, investment, or tax advice. Retirement planning is a deeply personal process, and the right strategy for you can only be determined through careful consideration of your own circumstances, ideally with the help of a qualified financial professional. So, what does it mean to plan for retirement? Financially speaking, it is the process of accumulating enough assets during your working years so that you can one day live comfortably without needing to earn a regular paycheck. It is the ultimate goal of financial independence. In the U.S., retirement income is often described as a three-legged stool, with each leg representing a different potential source of funds. The first leg is Social Security. This is a federal program that provides a baseline of income to retired workers, as well as to individuals with disabilities. It is funded by payroll taxes paid by both employees and employers. For most people, Social Security is intended to be a supplement, a foundation to build upon, not a complete replacement of their pre-retirement income. The future of the program is a subject of ongoing political discussion, which underscores the importance of not relying on it as your sole source of retirement funds. The second leg of the stool is employer-sponsored retirement plans. The most common of these is the 401k plan. A 401k is a type of defined contribution plan, meaning the employee and sometimes the employer contribute money to an individual account. This money is then invested, and the final retirement benefit depends on how much was contributed and how those investments performed. One of the most powerful features of many 401k plans is the employer match. This is a program where your employer contributes a certain amount to your account to match your own contributions, up to a specific limit. For example, an employer might match 100% of your contributions up to the first 3% of your salary. This is often seen as a key part of an employee's overall compensation package. Within a 401k, you will typically encounter two main types of contributions: traditional and Roth. With a traditional 401k, you contribute money before it has been taxed. This can lower your taxable income for the year. The money grows tax-deferred, meaning you don't pay taxes on the investment gains each year. However, when you withdraw the money in retirement, those withdrawals are taxed as ordinary income. With a Roth 401k, you contribute money that has already been taxed. Because of this, there's no upfront tax deduction. But the major potential benefit is that the money grows tax-free, and qualified withdrawals in retirement are also completely tax-free. The choice between traditional and Roth often depends on an individual's personal financial situation and their expectation of whether their tax rate will be higher or lower in the future. The third leg of the stool is personal retirement savings.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The primary vehicle for this is the Individual Retirement Arrangement, or IRA. As the name implies, this is an account that you open and fund on your own, separate from any employer. Anyone with earned income is generally eligible to contribute to an IRA. Just like 401(k)s, IRAs come in two main varieties: the traditional IRA and the Roth IRA. They operate on the same tax principles. A traditional IRA may offer a tax deduction on contributions today, with taxable withdrawals in retirement. A Roth IRA offers no upfront deduction, but qualified withdrawals in retirement are tax-free. The Internal Revenue Service, or IRS, sets annual limits on how much an individual can contribute to an IRA. So what kinds of investments are typically held inside these retirement accounts? While options can vary, two common choices found in many 401(k) plans are target date funds and index funds. A target date fund is designed to be a simple, all-in-one investment solution. You choose a fund with a year in its name that is closest to your expected retirement date, for example, a 2050 fund. The fund holds a diversified mix of stocks and bonds. Over time, the fund automatically adjusts its mix, gradually becoming more conservative, meaning more bonds and fewer stocks, as you get closer to that target date. An index fund is a type of mutual fund or ETF that aims to track the performance of a specific market index, like the S&P 500. It is a form of passive investing, offering broad market exposure and typically featuring lower management fees than actively managed funds. Revisiting a concept from our last chapter, the principle of compounding is especially powerful when it comes to retirement planning. Because the time horizon is so long, even small, consistent contributions made early in a career have the potential to grow substantially over several decades. This is why financial literature so often emphasizes the benefits of starting to save for retirement as early as possible. In conclusion, planning for retirement is a long-term project built upon a foundation of Social Security, supplemented by employer-sponsored plans like the 401(k), and further strengthened by personal savings in an IRA. Understanding the tools available, from the tax implications of traditional versus Roth accounts to the investment concepts of target date and index funds, is the first step toward building a secure future. Thank you for listening. In our next chapter, we will discuss a crucial element that protects your entire financial hub from unexpected shocks: the role of insurance. Hello, and welcome back to our ongoing series on building your personal finance hub. We have spent the last few chapters building the engine of our hub, learning to manage debt, understanding the principles of investing, and planning for the long-term goal of retirement. But a financial plan built only for growth, without any protection, is vulnerable. That's why today, we are talking about the shield. We are discussing the crucial role of insurance. As we begin, please remember our consistent message. This material is for educational and informational purposes only. It is not legal, financial, or health advice. Insurance is a complex field, and the appropriate types and amounts of coverage are highly personal. Decisions should only be made after consulting with a licensed and qualified insurance professional who can assess your specific needs. At its core, the concept of insurance is simple. It is a tool for risk management. Life is full of unpredictable events, some of which can have devastating financial consequences. Insurance is a mechanism that allows you to transfer the risk of a catastrophic financial loss to an insurance company. In exchange for a regular payment, known as a premium, the company agrees to provide a significant financial payout if a specific, covered event occurs. Think of it as a protective wall around the financial house you are so carefully building. Let's explore some of the most common types of insurance that form this protective shield. First, and arguably most important in the United States, is health insurance. The cost of medical care can be extraordinarily high, and a single major illness or accident can potentially wipe out years of savings. Health insurance is designed to mitigate these costs. When you have a health insurance plan, you'll encounter some key terms. The premium is the fixed amount you pay regularly, often monthly, to keep your policy active. The deductible is the amount of money you must pay out of pocket for covered services before your insurance plan starts to pay. After you meet your deductible, you may still pay a copay, which is a flat fee for certain services like a doctor's visit, or coinsurance, which is a percentage of the cost of a service. Finally, the out-of-pocket maximum is the absolute most you will have to pay for covered services in a plan year. For many, health insurance is obtained through an employer, but it can also be purchased through government-run marketplaces. Next, let's discuss life insurance. The fundamental purpose of life insurance is to provide financial support to your loved ones, known as beneficiaries, in the event of your passing. The money paid out, called the death benefit, can be used to replace lost income, pay off a mortgage, fund children's education, or cover final expenses. There are two primary categories of life insurance. Term life insurance provides coverage for a specific period, or term, such as 10, 20, or 30 years. It is often considered a pure insurance product. If the insured person passes away during the term, the benefit is paid. If the term ends, the coverage expires. Permanent life insurance, such as whole life, provides lifelong coverage as long as premiums are paid. These policies also include a savings component called a cash value, which can grow over time. These two types of policies serve different needs, and typically have very different premium costs. Another critical piece of the shield is disability insurance. Many people insure their homes, their cars, and their lives, but they often overlook what is arguably their most valuable asset: their ability to earn an income. Disability insurance is designed to protect your paycheck. If you become sick or injured and are unable to work for an extended period, disability insurance will replace a portion of your lost income. This allows you to continue paying your bills and funding your financial goals while you recover. Policies are generally categorized as short-term disability, which covers a period of a few months, and long-term disability, which can provide benefits for many years, sometimes even until retirement age. Finally, we have property and casualty insurance, which includes two types everyone is familiar with: auto insurance and homeowners or renters insurance. The purpose of this insurance is twofold. First, it protects the value of your physical assets, your car, your house, and your personal belongings, from damage or theft. Second, and just as important, it provides liability coverage. If you are found at fault in a car accident that injures someone, or if a guest is injured on your property, liability coverage helps protect you from potentially ruinous legal and medical costs. Insurance companies determine whether to offer you a policy and how much to charge in premiums through a process called underwriting. This is simply a risk assessment. For life or health insurance, they may look at your age, your health history, and your lifestyle. For auto insurance, they'll consider your driving record, your vehicle, and where you live. In conclusion, insurance is the defensive component of your financial hub. It is the shield that protects your savings, your investments, and your family's future from the unexpected. Your insurance needs are not static. They will change as your life changes. When you get married, have children, buy a home, or change jobs. Regularly reviewing your coverage is a vital part of maintaining a healthy financial plan. Thank you for listening. In our next chapter, we'll shift our focus back to planning for the future by exploring how to set and save for major financial goals beyond retirement. Hello and welcome back to our comprehensive guide to building your personal finance hub. We have covered the foundation of banking, the management of debt, the principles of investing, the long-term goal of retirement, and the protective shield of insurance. But a rich life is often measured by a series of milestones, not just the finish line of retirement. Today, we're focusing on how to plan for those other major life goals. As we navigate this topic, we stand by our essential principle. This content is for educational and informational purposes only. It is not financial or tax advice. The strategies and accounts discussed are general concepts, and the right path for your specific goals should be determined in consultation with a qualified financial professional. While retirement is a universal long-term goal, your personal financial journey will be unique, filled with aspirations like buying a first home, funding a child's education, starting a business, or traveling the world. The key to turning these dreams into reality is to transform them from vague wishes into concrete plans. A widely used framework for this is setting SMART goals. SMART is an acronym that stands for specific, measurable, achievable, relevant, and time-bound. For example, a vague goal is, I want to buy a house someday. A SMART goal is, I want to save $40,000 for a home down payment in the next 5 years. This clarity is the first and most critical step. Let's explore how to approach a few common major goals within your finance hub. Perhaps the most significant financial milestone for many, besides retirement, is buying a home. The biggest initial hurdle is typically the down payment. This is the portion of the home's purchase price that you pay up front in cash, with the rest being covered by a loan or mortgage. The size of your down payment affects your loan amount, your monthly payment, and potentially your interest rate. You may have heard the common guideline of a 20% down payment. The primary reason for this benchmark is to avoid paying something called private mortgage insurance, or PMI. PMI is a type of insurance that protects the lender in case you are unable to make your payments. and it is often required for down payments under 20%. However, it's important to know that many types of loan programs exist, including some backed by the federal government, that allow for down payments as low as 3 to 5%. Since a down payment is a midterm goal, something you are likely saving for over a period of 3 to 7 years, the priority for this money is typically safety and accessibility. For this reason, many people choose to save for a down payment in a vehicle like a high-yield savings account, which we discussed in Chapter 2. This keeps the principal safe from market fluctuations while still allowing it to earn some interest. Another major long-term goal for many families is saving for education. With the costs of higher education continuing to rise, planning ahead has become increasingly important. To help families save, the U.S. government has created specialized, tax-advantaged accounts. The most prominent of these is the 529 plan. A 529 plan is an investment account designed specifically to encourage saving for future education costs. Their primary benefits are tax-related. Contributions may sometimes be deductible on your state tax return, depending on your state's rules. The money in the account can then be invested and grows on a tax-deferred basis. Finally, withdrawals are completely tax-free at the federal level, provided the money is used for qualified education expenses, which can include tuition, fees, books, and room and board at eligible colleges, universities, and vocational schools. These plans are sponsored by individual states, but you are generally not restricted to using your home state's plan. Another, less common option is the Coverdell Education Savings Account, ESA. It functions similarly with tax-free growth and withdrawals, but has much lower annual contribution limits and income restrictions for the contributor. These are simply tools in the financial toolbox, designed for a very specific purpose. Of course, there are many other major life milestones to plan for, such as buying a new car, funding a wedding, or taking a once-in-a-lifetime trip. These are typically shorter-term goals. A highly effective strategy for these types of expenses is creating sinking funds. A sinking fund is simply a dedicated savings account for a single, specific goal. Instead of being surprised by a future large expense, you calculate the total cost and the time frame, and then you sink a fixed amount of money into that fund each month. For example, if you know you want to buy a $6,000 item in 2 years, you would create a sinking fund and save $250 a month for 24 months. This proactive approach turns a potential financial shock into a manageable, planned expense. The key to successfully funding all these different goals is a concept we've already discussed: automation. The most effective way to save is to make it automatic. You can open multiple, separate savings accounts and nickname them for their specific purpose. Home down payment, new car fund, vacation 2027. Then, set up automatic recurring transfers from your primary checking account into each of these savings accounts every single payday. This enforces discipline and builds progress toward your goals without requiring constant effort. By defining your goals, understanding the tools available for each, and automating your contributions, your financial hub becomes a powerful machine, working systematically not just toward a comfortable retirement, but toward the rich and fulfilling life you envision along the way. Thank you for listening. In our next chapter, we will demystify a topic that touches every aspect of our financial lives: the basics of the U.S. tax system. Hello and welcome back to our series on constructing your personal finance hub. We have now covered banking, debt, investing, retirement, insurance, and goal setting. Today we address the one topic that connects to every single one of those areas: taxes. The U.S. tax system can feel incredibly complex, but understanding its basic concepts is essential for navigating your financial life. This chapter comes with our most important disclaimer yet. The information provided here is for high-level educational and informational purposes only. It is in no way intended to be tax or legal advice. Tax laws are incredibly complex, change frequently, and are based on individual circumstances. For any specific questions or for assistance in preparing your tax return, you must consult with a qualified professional, such as a certified public accountant (CPA), an enrolled agent, or use reputable tax preparation software. First, let's start with the why. At its most basic level, taxes are the primary way that governments, federal, state, and local, raise money. This revenue is used to fund public services that benefit society, such as building and maintaining infrastructure like roads and bridges, funding the military, supporting education, and operating social programs. To understand your own tax situation, it helps to know the language. Let's define a few key terms that represent the journey your income takes on a tax return. It starts with your gross income. This is, broadly speaking, all the money you receive during the year from all sources. This includes your salary from a job, income from a side business, tips, and potentially investment returns. From there, certain specific deductions are subtracted to arrive at a very important number: your adjusted gross income, or AGI. The AGI is a key figure used to determine your eligibility for various tax deductions and credits. After calculating your AGI, you then subtract another set of deductions to arrive at your taxable income. This is the actual amount of your income that is subject to tax. For this step, you generally have two choices. You can take the standard deduction, which is a fixed dollar amount determined by the government based on your filing status, age, and other factors. It's a straightforward way to reduce your taxable income without having to track specific expenses. Alternatively, you can choose to itemize deductions. This involves adding up all of your eligible, specific expenses throughout the year. Common itemized deductions can include things like mortgage interest, state and local taxes up to a certain limit, and charitable contributions. A person will typically choose whichever option. The standard deduction, or their total itemized deductions, results in a larger deduction, and therefore a lower taxable income. This brings us to one of the most important distinctions in the tax code: tax deductions versus tax credits. A tax deduction reduces your taxable income. For example, a $1,000 deduction lowers the amount of your income that is subject to tax. A tax credit is generally more powerful. It is a dollar-for-dollar reduction of your actual tax bill. A $1,000 tax credit reduces the amount of tax you owe by the full $1,000. Think of it this way. A deduction is like a discount on the price of an item before tax is calculated, while a credit is like a coupon you hand the cashier that reduces your final bill. So how is the tax itself calculated? The United States uses a progressive tax system with marginal tax brackets. This is a concept that is widely misunderstood. It does not mean that all of your income is taxed at the rate of your highest bracket. Think of the tax brackets like a series of buckets. The first bucket, representing the lowest tax bracket, gets filled up with your first dollars of taxable income, and those dollars are taxed at that low rate. Once that bucket is full, any additional income spills over into the next bucket, which represents the next tax bracket. Only the money that falls into that second bucket is taxed at that second, higher rate. This continues up the brackets. So even if a raise pushes you into a higher tax bracket, you don't lose money. Only the new dollars you earn above the previous bracket's threshold are taxed at the new, higher rate. Beyond federal income tax, you'll encounter other taxes. These include payroll taxes, often referred to as FICA, which fund Social Security and Medicare, and are typically withheld directly from your paycheck. There are also capital gains taxes, which are taxes on the profit you make from selling an asset, like a stock. The tax rate for capital gains often depends on how long you held the asset, with a distinction between short-term, held for 1 year or less, and long-term, held for more than 1 year. Your financial hub is full of decisions that have tax implications. The choice to contribute to a traditional 401k, for instance, can reduce your taxable income for the year. The interest you pay on a mortgage might become an itemized deduction. Understanding that these connections exist is the first step to making informed financial choices. In summary, the tax system is a core component of personal finance. By understanding the key vocabulary, like AGI, deductions, and credits, and grasping the concept of our progressive tax bracket system, you can better understand how taxes impact your overall financial picture. Thank you for listening. Next time, we'll bring many of our concepts together as we discuss the practical application of budgeting and financial tracking to keep your hub running smoothly. Hello and welcome back. Over the past 8 chapters, we have carefully assembled the major components of a robust personal finance hub. We have a solid banking foundation, a plan for managing debt, an engine for long-term growth through investing, a strategy for retirement, a shield of insurance, and a blueprint for navigating taxes and life goals. Now, it's time to build the control panel, the central dashboard you'll use to operate this entire system on a day-to-day basis. We're talking about budgeting and financial tracking. As we proceed, please remember that this chapter, like all others, is for educational and informational purposes only. The methods discussed are general philosophies, not direct financial advice. The best system is always the one that you can personally stick with. Let's start by redefining the word budget. For many people, the word budget has negative connotations. It can sound restrictive, like a financial diet of constant deprivation. But a more empowering way to view a budget is as a conscious spending plan. It's not about restricting yourself. It's about making sure your money is aligned with your personal values and goals. It's the tool that gives you permission to spend, because you've planned for it. A budget doesn't tell you that you can't have something. It just helps you create a plan to get it. There is no single correct way to budget. The best approach depends on your personality, your goals, and how hands-on you want to be. Let's explore a few popular philosophies. One well-known starting point is the 50/30/20 guideline. This is not a strict rule, but a simple framework for categorizing your after-tax income. The idea is to allocate roughly 50% of your income to your needs. These are the essential expenses you must pay, like housing, utilities, transportation, and groceries. The next 30% is allocated to wants. This includes discretionary spending like dining out, entertainment, hobbies, and shopping. The final 20% is directed towards savings and debt repayment. This includes contributions to your emergency fund, retirement accounts, and extra payments on any high-interest debt. This guideline is useful for getting a quick, high-level view of where your money is going. For those who prefer more detail and control, there is the zero-based budget. The philosophy here is simple. Income minus expenses must equal zero. At the beginning of each month, you assign a specific job to every single dollar you expect to earn. You allocate money to bills, savings, investments, debt payments, and all of your spending categories until there is nothing left. This method requires a high degree of intentionality and forces you to account for all of your money, which can be very effective for optimizing your finances. A third, more simplified approach is the pay yourself first method, sometimes called a reverse budget. With this system, your savings goals are the top priority. Before you pay any other bills, you decide how much you want to save and invest. Then, you automate the transfer of that amount from your checking account to your savings and investment accounts on payday. After you have paid yourself first, the rest of the money in your checking account is available to cover your bills and other spending for the month. This method ensures your future goals are always funded. So, how do you actually track all of this? Again, you have options. For those who like a hands-on approach, a simple notebook or a computer spreadsheet can be incredibly effective. This method offers complete control and customization. For those who prefer automation, there are many financial aggregation and budgeting apps available. These tools can securely link to your various bank and credit card accounts, automatically download your transactions, and help you categorize them. This can provide a real-time, comprehensive view of your spending habits with minimal manual entry. The process of starting is straightforward. First, understand your income. Know exactly how much money you have coming in each month after taxes. Second, track your spending for a period, like 1 month, without judgment. The goal is simply to gather data and see where your money is actually going. Third, create your plan. Choose one of the budgeting philosophies we discussed, or a hybrid of them, and create categories that make sense for your life. Finally, put your plan into action and track your progress. The most important rule of budgeting is this. A budget is a living document, not a stone tablet. Life happens. Unexpected expenses will come up. Your income might change. The goal is not perfection, it's progress and awareness. Plan to sit down with your budget for a few minutes each week, or at the end of each month. See how you did, and make adjustments for the upcoming month. A budget should be flexible enough to adapt to your life. In conclusion, your spending plan is the command center of your financial hub. It's the system that connects your daily decisions to your long-term aspirations. It ensures that the money flowing through your foundational bank accounts is being directed purposefully toward your goals, investments, and debt reduction plans. Thank you for listening. In our next chapter, we will explore a powerful way to accelerate all of your financial goals, focusing on career development and income growth. Hello, and welcome back to our series on building your personal finance hub. We have designed our hub, installed its core components, and created a control panel with a conscious spending plan. Our system is built and ready to run, but any powerful system needs fuel to operate effectively. In personal finance, that fuel is your income. Today, we're shifting our focus from managing the money you have to strategies for increasing the money you earn. Before we begin, it's important to state that this chapter provides a general overview of career development and income-generating concepts. It is not career coaching or a guarantee of financial success. Personal career paths are unique, and the strategies discussed here are broad ideas intended to inspire your own research and planning. Think of your income as the energy that powers every single part of your financial hub. A larger, more consistent flow of income allows you to accelerate all of your goals. It can mean paying off debt faster, increasing your investment contributions, saving for a down payment more quickly, and ultimately, reaching financial independence sooner. While managing your money wisely is critical, Strategically growing your income is the other half of the financial equation. There are generally two primary levers you can pull to increase your income: maximizing your primary career and exploring additional income streams. Let's look at each. For most people, the most significant and stable source of income is their primary job or career. Intentionally managing your career path can be one of the most impactful financial activities you undertake. This involves a few key areas. First is a commitment to continuous skill development. In today's rapidly changing economy, the skills that are valuable are constantly evolving. This means embracing the idea of lifelong learning. This could involve pursuing professional certifications in your field, taking online courses to learn a new software or technique, or attending industry conferences. It also includes developing soft skills, such as communication, leadership, and project management, which are highly valued in any profession. Staying relevant and increasing your capabilities makes you a more valuable member of your team and industry. Second is advocating for your value. This often involves salary negotiation. It is a standard and expected part of professional life to discuss your compensation. Preparation is key to these conversations. This involves researching industry benchmarks for your role, experience level, and geographic location to understand the market rate for your skills. It also means keeping a running list of your accomplishments, successful projects, and any positive feedback you've received. This allows you to build a clear, data-driven case for why your contributions are valuable to the organization. The second lever for income growth is exploring additional income streams, often called a side hustle. This is a way to diversify your income so you aren't solely reliant on one source, and it can provide extra cash flow to accelerate your goals. There are many forms this can take. One common approach is to monetize a skill or hobby. If you are skilled in graphic design, writing, photography, or music, you may be able to take on freelance projects. If you have expertise in a particular academic subject, you could offer tutoring services. Another avenue is the gig economy. App-based platforms have made it easier to earn income through activities like ride-sharing, food delivery, or performing small tasks and errands for others. These options often provide a high degree of flexibility. A third path is selling products. This could range from selling handmade crafts on an online marketplace to finding and reselling items. This path often requires an understanding of inventory, marketing, and customer service. It's important to approach any side business with diligence, understanding the time commitment required, any potential startup costs, and the tax implications of your new income. Now for the most critical step: what to do with this new increased income. There is a common phenomenon known as lifestyle inflation, where an individual's spending increases in lockstep with their earnings, leaving them in the same financial position as before, just with more expensive things. This is where your financial hub's control panel, your budget, is essential. Any additional income from a raise, bonus, or side hustle should be directed with purpose. Before it gets absorbed into daily spending, you assign it a job. You could use it to make a large extra payment on your highest interest debt. You could use it to max out your IRA contributions for the year. Or you could use it to top off your home down payment fund. By consciously directing new money into the components of your financial hub, you turn income growth into real, measurable progress toward your goals. In conclusion, your income is not a static number. It is a dynamic variable that you can influence through proactive career management and the exploration of new opportunities. By focusing on growing the fuel that powers your financial hub, you can significantly shorten the timeline to achieving the life you want. Thank you for listening. In our next chapter, we will explore the intersection of finance and relationships, discussing how to manage money as a team. Hello, and welcome back to our series on building your personal finance hub. Thus far, we have focused primarily on building a system for you as an individual. But for many, a major part of life involves sharing it with a partner. When two lives merge, so do their financial realities. Today, we're exploring one of the most important and often challenging aspects of personal finance: managing money as a team. Before we delve in, it is essential to state that this chapter discusses general approaches and communication strategies. It is not relationship counseling, nor is it legal or financial advice. Every partnership is unique, and the right system is one that both partners agree upon and feel respected by. For a financial partnership to succeed, the single most important ingredient is not the structure of your bank accounts, but the quality of your communication. Open, honest, and regular conversations about money are the bedrock of a healthy financial team. This means moving past the idea that money is a taboo topic. A practical way to foster this is to schedule a regular money date. This is a dedicated, low-stress time for you and your partner to sit down and talk about your finances. It's not a time for blame or criticism. It's a time to review your progress, celebrate financial wins, like paying off a credit card or hitting a savings goal, and plan for upcoming expenses. Consistent communication prevents small misunderstandings from growing into major conflicts.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Hand in hand with communication is financial transparency. This means both partners have a clear and complete picture of the team's finances. This includes all income sources, all assets like savings and investment accounts, and all liabilities, including student loans, car loans, and credit card debt. Transparency isn't about controlling each other's spending. It's about making decisions from a shared foundation of knowledge. Once communication and transparency are established, the next step is to decide on a practical system for managing your cash flow. There is no one-size-fits-all answer, but most couples adopt one of three common structures. The first is the all-in or fully joint approach. In this system, both partners deposit their entire paychecks into one or more shared accounts. All household bills, personal spending, and savings contributions are paid from these joint funds. The primary benefit of this method is its simplicity and the sense of a complete financial union. It can make tracking and budgeting very straightforward. A potential consideration is ensuring both partners feel they have a degree of personal spending autonomy. The second structure is the yours, mine, and ours or hybrid approach. Here, each partner maintains their own separate checking or savings account for personal, discretionary spending. They then both contribute an agreed-upon amount of money to a joint account. This joint account is used to pay for all shared expenses, such as rent or mortgage, utilities, groceries, and funding for shared goals. This method is often seen as a balance, providing individual autonomy while still promoting teamwork for shared responsibilities. The third structure is the separate but equal approach. In this system, partners keep their financial lives almost entirely separate. They each have their own accounts, and there may be no joint accounts at all. They work out a system for who pays for which shared bills. For instance, one partner might pay the mortgage while the other covers utilities and groceries. This method offers the maximum amount of financial independence. The key challenge here is to ensure that both partners are still working together and contributing equitably toward shared long-term goals, like retirement. It's also important to acknowledge that very few partnerships have perfectly equal financial situations. It is common for one partner to earn a higher income, have more savings, or carry more debt. These differences don't have to be a source of conflict. Instead, they require an open conversation about what feels fair and equitable. For shared expenses, some couples contribute an equal 50-50 split, while others choose to contribute proportionally based on their income. The goal is to find a system where both partners feel they are contributing fairly to the team's success. Finally, it's worth noting that for couples who want to formally outline their financial arrangements, particularly before marriage, legal tools such as prenuptial agreements exist. These are a component of financial and estate planning that can provide clarity for both individuals. In conclusion, managing finances with a partner is less about a rigid set of rules and more about building a collaborative team. It's founded on open communication, built with a structure that you both agree on, and aimed at achieving a shared vision for the future. Thank you for joining me. In our next chapter, we will dive into a fascinating topic that influences all of our decisions: the psychology of money, also known as behavioral finance. Hello and welcome back. Throughout this series, we have meticulously designed and assembled the systems of a personal finance hub. We have covered the logical, mechanical, and strategic components of money management. But today, we're going to talk about the most unpredictable variable in the entire equation: the human mind. We're diving into the fascinating field of behavioral finance, or the psychology of money. As we begin, please remember our consistent theme. This chapter is for educational and informational purposes only. It is not psychological analysis or investment advice. The concepts discussed are general principles to help you understand common human tendencies. True self-awareness is a personal journey. Traditional economic theory is often built on the idea that humans are rational beings who always make logical choices to maximize their own self-interest. But if you've ever bought something you didn't need just because it was on sale, or felt a pang of panic when the stock market dropped, You know that our decisions are often driven by something other than pure logic. They are driven by emotions, mental shortcuts, and deeply ingrained psychological biases. Behavioral finance is the field that studies this intersection of psychology and economics. The goal today is not to eliminate these tendencies. They are a natural part of being human. The goal is to become aware of them. By understanding the why behind some of our financial impulses, we can better rely on the logical systems we've built in our financial hub. Let's explore a few of the most powerful and common behavioral biases. First, there is loss aversion. Psychologically, the pain of losing something is often twice as powerful as the pleasure of gaining the same thing. For example, the emotional sting from losing a $100 bill is typically much more intense than the joy you would feel from finding a $100 bill. In terms of finance, this can lead to irrational decisions. An investor might hold on to a losing stock for far too long, not because of a logical belief in the company's future, but because selling it would mean locking in the loss, which feels intensely painful. To avoid that pain, they might risk even greater losses. Next is the herd mentality, also known as social proof. As social creatures, we are wired to look to others for cues on how to behave, especially in times of uncertainty. When it comes to finance, this can manifest as following the crowd. When everyone is excitedly buying a particular type of investment, and stories of massive gains are everywhere, the fear of missing out, or FOMO, can compel people to jump in without doing their own research. Conversely, when the market takes a downturn and news headlines are filled with panic, the herd rushes to sell. Following the herd can often mean buying high and selling low, the exact opposite of a sound strategy. Another common bias is overconfidence. Most people tend to rate their own abilities as above average, and this extends to finance. We may overestimate our ability to pick winning stocks, to time the market, or to know when to get in or out of an investment. This overconfidence can lead to excessive trading, which can rack up transaction costs and taxes, or it can lead to taking on far more risk than is appropriate for our goals, because we underestimate the potential for things to go wrong. Finally, let's consider confirmation bias. This is the natural tendency to search for, interpret, and favor information that confirms our pre-existing beliefs. If you've decided that a particular investment is a brilliant idea, you will subconsciously seek out news articles, videos, and opinions that support your decision, while dismissing or ignoring any evidence to the contrary. This creates an echo chamber that reinforces your initial belief, making it very difficult to objectively reevaluate your position if circumstances change. So, if our minds are filled with these biases, how do we protect our financial hub? This is where the systems we have already built come into play. Your financial plan is your best defense against your own emotional impulses. Automation, which we discussed in Chapter 2, is a powerful tool against these biases. By automatically transferring money to your savings and investment accounts every payday, you take emotion out of the equation. A well-thought-out, long-term investment plan based on diversification is the antidote to the herd mentality. When you have a clear plan, you are less likely to be swayed by the market's daily emotional swings. Your conscious spending plan or budget helps protect you from making impulsive decisions based on a fear of missing out or other emotional triggers. In conclusion, behavioral finance teaches us that building a sound financial future is not just about spreadsheets and market analysis. It's also about understanding ourselves. By recognizing our inherent biases, we can appreciate the immense value of creating a logical, systematic financial hub and developing the discipline to stick to it. Thank you for joining me. In our next chapter, we will discuss a vital, forward-looking topic, the basics of estate planning. Hello and welcome back to our series on building and managing your personal finance hub. We have spent a great deal of time learning how to organize our finances for our own lives, to achieve our goals and secure our futures. Today, we're going to discuss the final step in creating a truly comprehensive plan. Ensuring the assets you've worked so hard to build are handled according to your wishes after you're gone. We are introducing the basics of estate planning. This chapter comes with our most serious and direct disclaimer. The information provided here is for general educational purposes only, and is intended to introduce you to common concepts and vocabulary. It is absolutely not legal or financial advice. Estate planning is a complex legal process that is governed by specific federal and state laws. To create a valid and effective estate plan, it is essential that you consult with a qualified attorney in your state. Do not attempt to act on this information without professional legal guidance. So what is an estate plan? Let's first dispel a common myth. Estate planning is not just for the wealthy. If you have any assets at all, a bank account, a car, a home, an investment portfolio, you have an estate. Estate planning is simply the process of creating a clear set of legal instructions for how your assets should be managed and distributed after your death, or how your personal and financial affairs should be handled if you become unable to make decisions for yourself. It is the ultimate act of financial organization, and a final gift of clarity to your loved ones. The goal of estate planning is to answer a few critical questions. Who do you want to inherit your assets? Who should be in charge of managing your affairs and carrying out your instructions? Who should care for your minor children? And who should make medical decisions for you if you cannot? To answer these questions, an estate plan typically involves several key legal documents. Let's define what they are. The most well-known document is the last will and testament, or simply a will. A will is a legal document that states your wishes regarding the distribution of your property. It is also the document where you can name a guardian for any minor children. Within your will, you name an executor, a person or institution you trust to be in charge of carrying out the will's instructions, such as paying off any final debts and distributing your assets. Another key component you may have heard of is a trust. A trust is a legal entity that can hold and manage assets on behalf of beneficiaries. The person who manages the trust is called the trustee. Trusts can serve many different purposes and can be structured in many ways. One function of certain types of trusts is that they can allow assets to pass to beneficiaries outside of the public legal process, known as probate. Probate is the generally court-supervised process of validating a will, settling any outstanding debts, and formally distributing assets to heirs. Estate planning isn't just about what happens after you die. It's also about preparing for a time when you might be alive but unable to make your own decisions, a situation known as incapacitation. This is where two other documents become vital. A durable power of attorney for finances is a legal document that lets you appoint someone to manage your financial affairs if you become incapacitated. This person could pay your bills, manage your bank accounts, and handle other financial matters on your behalf. A healthcare directive, which may also be called a living will or a healthcare proxy, outlines your wishes for medical treatment. It allows you to state what kind of life-sustaining measures you would or would not want. It can also appoint a specific person to make medical decisions for you if you are unable to communicate them yourself. Beyond these formal legal documents, there is one simple yet incredibly powerful piece of estate planning that applies to almost everyone: reviewing your beneficiary designations. Many of your most significant financial accounts, such as your 401k, your IRA, life insurance policies, and some bank accounts, allow you to name a beneficiary directly on the account. This is who will receive the asset upon your death. It is critical to understand that these beneficiary designations often supersede, or override, what is written in your will. Keeping these designations up to date after major life events, like a marriage, divorce, or the birth of a child, is one of the most important and easiest parts of estate planning. In conclusion, an estate plan is the instruction manual you create for your financial hub's future. It provides clarity, minimizes potential conflict, and ensures your final wishes are honored. Once again, this has been a high-level overview of complex topics. To protect yourself and your loved ones, please seek the guidance of a qualified estate planning attorney to create documents that are legally valid and tailored to your specific situation. Thank you for listening. In our next chapter, we'll discuss the importance of continuous financial education and how to stay informed in an ever-changing world. Hello, and welcome back to our series on building your personal finance hub. Over the course of 13 chapters, we have laid the foundation, built the structure, and future-proofed a comprehensive system for managing your financial life. But a structure, no matter how well built, requires maintenance and adaptation to stand the test of time. Today, we're talking about the ongoing commitment that keeps your hub strong and relevant: the practice of lifelong financial literacy. As we explore this topic, we continue to uphold our core principle. This material is for educational and informational purposes. Our goal is to provide a framework for learning, not to provide financial advice or endorse any specific resource. Think of the knowledge you've gained in this series as earning your driver's license for your financial hub. You now understand the rules of the road and how to operate the vehicle. Financial literacy, however, is the act of continuing to be a good driver. It means staying aware of changing road conditions, keeping your vehicle well maintained, and occasionally learning new driving techniques. The financial world is not static. Tax laws change, new financial products are introduced, and economic conditions shift. Similarly, your own life is not static. Your income will change, your family situation may evolve, and your goals will mature. A commitment to continuous learning ensures that your financial hub can adapt to all of these changes. A key part of lifelong learning is becoming a critical consumer of financial information. In the digital age, we are surrounded by financial content, from news articles and social media posts to podcasts and videos. While much of it can be helpful, some can be misleading or designed with a hidden sales agenda. To navigate this landscape, it's helpful to adopt a mindset of healthy skepticism and ask a few key questions whenever you encounter a piece of financial content. First, who is the source? Is it a neutral government agency, an established news organization with journalistic standards, or an individual influencer who might be getting paid to promote a product? Second, what is their motivation? Is the primary goal to educate and inform, or is it to sell you a specific investment, an insurance policy, or an expensive course? And third, is this education or advice? Is the content explaining a general concept, or is it telling you specifically what you should do with your money? So, where can you look for reliable, educational information? While we won't name specific brands or personalities, we can point you toward trustworthy categories of resources. A fantastic starting point is the websites of U.S. government and regulatory agencies. Organizations like the IRS, the SEC or Securities and Exchange Commission, and the CFPB or Consumer Financial Protection Bureau have a primary mission to protect and inform the public. Their websites are filled with a wealth of free, unbiased, and factual educational materials, glossaries, and tools. Another excellent category is nonprofit organizations. There are numerous nonprofits dedicated to promoting financial literacy across the country. Because their mission is educational rather than commercial, they can be a source of objective information, workshops, and counseling. Well-established financial journalism can also be a valuable resource for understanding the bigger picture. The goal isn't to get hot stock tips, but to gain a general understanding of economic trends, changes in interest rates, and how global events might impact the financial landscape over the long term. Of course, there is a vast world of books, podcasts, and other media on personal finance. When exploring these, it can be helpful to look for creators who focus on timeless principles, like budgeting, debt management, and long-term, diversified investing, rather than those who promise quick, guaranteed returns. It can feel overwhelming to try and learn everything at once. A more practical approach is what could be called just-in-time learning. This means you don't need to be an expert on every financial topic simultaneously. Instead, you can focus your learning on the financial decisions that are most relevant to your current life stage. If you're about to buy your first home, that's the time to dive deep into understanding mortgages. If you're expecting a child, that's the perfect time to research the details of education savings accounts. Finally, it is crucial to understand the goal of financial literacy. The purpose of educating yourself is not to replace the advice of qualified professionals. Instead, the goal is to become a more confident and engaged partner in your own financial life. An educated individual can ask better questions, more clearly understand the recommendations they receive from a financial advisor or attorney, and feel a greater sense of ownership over their financial plan. In conclusion, building your financial hub was a project. Maintaining it through lifelong learning is a practice. By committing to being a curious, critical, and continuous learner, you ensure that your financial hub will not only serve you well today, but will adapt and grow with you for the rest of your life. Thank you for listening. In our final chapter, we will bring everything together, summarizing the core principles of the financial hub, and leaving you with a clear path forward. Hello, and welcome back for the final chapter of our series on building your personal finance hub. For the past 14 chapters, we have been on a journey together, constructing a complete and integrated system for managing your financial life. Today, our goal is to step back and look at the finished structure, to see how all the individual pieces connect and work together, and to leave you with a clear vision for the path forward. Let's begin by revisiting the core concept that started it all. The financial hub is not a product you buy, but a system you build. It's a way of thinking that transforms a scattered collection of accounts, debts, and goals into an organized, understandable, and intentional plan. We started by pouring the foundation, a streamlined banking and cash flow system. We learned the importance of creating dedicated accounts for operating expenses and for short-term savings, and using the power of automation to make saving and investing a consistent, effortless habit. With that foundation in place, we addressed credit and debt, reframing them as powerful tools. We learned that understanding your credit report and score is vital, and that having a systematic plan, whether it's the avalanche or snowball method, is the key to managing liabilities effectively. Next, we built the engine of our hub, investing. We introduced the core principles of risk and reward, the power of compounding over time, and the critical strategy of diversification. We explored the primary retirement savings vehicles, the 401k and the IRA, as the cornerstones of a long-term plan for financial independence. But a strong structure needs protection. We wrapped our hub in a shield of insurance, understanding its role not as an investment, but as a risk management tool that protects your assets, your income, and your loved ones from catastrophic financial shocks. We then expanded our vision beyond retirement, discussing how to set and save for other major life goals, like a home down payment or a child's education, using the right tools for the right time horizon. We navigated the complex world of taxes, demystifying the vocabulary and understanding the basics of our progressive tax system, so you can better grasp how it connects to your financial decisions. To run the entire system, we designed a control panel, a conscious spending plan. We redefined the budget not as a restriction, but as a tool for empowerment that aligns your spending with your values and directs your most important asset, your income, with purpose. And we didn't stop there. We discussed how to fuel the hub by proactively managing your career and income growth, and how to direct that new income to accelerate your progress. We explored the dynamics of managing money and relationships, emphasizing that communication and shared goals are the foundation of a successful financial team. We delved into the psychology of money, learning to recognize the behavioral biases that can lead us astray, reinforcing the need for a logical, systematic plan. We future-proofed our hub with an introduction to estate planning, ensuring our wishes are clear and our loved ones are cared for. And finally, we committed to being lifelong learners, staying financially literate in an ever-changing world. Now, as you look at this complete picture, the most important takeaway is this: your financial hub is a flexible blueprint, not a rigid set of rules. The goal is to build a system that works for your life, your personality, and your unique goals. The journey is one of progress, not perfection. You can start small, by taking one step, like tracking your spending for a month, or checking your beneficiary designations, or starting a conversation with your partner. As we conclude, we must end with our most important and final reminder. This entire series has been created for educational and informational purposes only. It is not, and should never be considered, a substitute for personalized professional advice. The worlds of finance, investing, tax, and law are complex and deeply personal. We have given you a map of the territory, but to navigate it safely and effectively, we strongly encourage you to work with qualified, licensed professionals, such as a financial advisor, a certified public accountant, and an estate planning attorney, who can guide you based on your individual circumstances. Thank you for investing your time in this journey. You have equipped yourself with the knowledge to build a more secure and intentional financial life. The ultimate purpose of a financial hub is not just to accumulate wealth, but to use it as a tool to create a life of security, freedom, and peace of mind. We wish you the very best as you put your plan into action.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.